Hey everyone, this is the Halifax Real Estate Podcast. My name is Jason Paul and I'm a licensed realtor at Keller Williams Select Realty in Halifax, Nova Scotia. I'm here to help you gain a better understanding of real estate in Halifax and introduce you to a wide variety of people that work in or with our industry as well. Scott Gannon is the founder and wealth coach of Scott Gannon Financial Inc. Scott's business works best with business owners and real estate investors using a unique method to add return on investment to existing business or real estate investments called the Infinite Banking Tool or Become Your Own Banker Strategy. Please welcome Scott Gannon. Hey Scott, how are you?
Very good, very good. How about yourself?
I'm good. Thank you so much for coming on today. Thank you for the time. I guess the first question I have is how did you get into financing and helping people build wealth?
Well, that kind of started, it was almost been a bit of an accidental thing in that I came out of school in 94 and no job and did an aptitude test. And what it says is I'm really good at finance and I like people.
Yeah.
So the natural point for that was to get into financial planning. So that started in 94 and I was going to be, the what I call the mutual fund guru. And for the first 6 years, I guess I was with double-digit returns, and the market made it easy until it wasn't. So back when in 2001, 2002, we had a recession.
.com boom.
.com boom went bust, and we were basically 50% lower. All of a sudden, I kind of understood why, but couldn't really control it. But then we came out of the recession, and what was I saying to people then was, this is the best time in a generation. These kind of drops only happen once in a generation. And now's the time to buy. And lo and behold, a generation is now in dog years because it happened again in 2008. So that put me on a bit of a mission to find a better way. And I kind of touched on earlier in the first recession, actually, I kind of touched on looking at real estate and studying it a little bit. And then after the second drop, I got really serious about it and started talking to just different people that had some experience in it and started studying lots about real estate. Ended up taking a multifamily course in the U.S. back in 2012. And that's when we really got serious. We ended up buying a couple apartment buildings in Florida. And things weren't great. It was, this is the answer, so to speak. And then I kept doing what I was doing, didn't hide anything. Clients were very, very much aware of what I was doing. And I was still managing their money. And then I was introduced about 5.5 years ago to a process that is right in my wheelhouse under my licensing or what I do, my day job, so to speak. And that changed everything for me in that now I had a way to stay attached to the real estate business, but also stay in the business that I actually do love. Although I didn't love the asset gathering part of it. I do love helping people.
Yeah. So when you talk about that thing you do on a day-to-day basis, what do you do on a day-to-day basis?
So on a day-to-day basis now, I have long-term clients that, I still have assets under management, so to speak, that are invested in mutual funds or guaranteed funds and so on. But on a day-to-day basis now, I help people build wealth through a process called infinite banking.
Okay. And what is infinite banking?
So infinite banking really is a process. It's a process where you accumulate money and use that money for both planned and unplanned events as well as opportunities. And the key point of that is you use the money. You don't spend the money. You just use it. So it's for all intents and purposes a leveraging technique that is very safe.
Okay. So when you say use the money, you don't spend the money, how do you use the money? Like where does that money come from?
So the process is you accumulate it in a specially designed high cash value dividend paying life insurance policy. And this is, pardon me on this. I'm going to have to get a little technical on this, but
by all means.
So the type of policy that it is just to put it into perspective, 0.25% of all insurance policies in Canada are written this way.
Okay.
So it's written that it's designed. So the first thing you have to understand about participating whole life insurance is it's not just life insurance. It is a savings vehicle, and it has certain tax advantages that nothing else has, in that as you accumulate the money, it's never taxed. As the money gets accumulated inside the policy, you can leverage off of it, meaning borrow against the policy. So the cash in the policy is your collateral.
Yep.
On demand. So
On demand.
On demand. You don't have to apply for it. You pay an interest rate, but there's no terms attached to it. You don't apply for it. You don't have to make payments on it. All you have to do is be responsible for the fact that you have collateral that's growing while this is happening.
Yep.
Against it.
Okay. You unloaded a lot there, a lot of good technical little terms. I'm going to try and pick this apart.
Okay.
So basically, the basic idea is that you take out a life insurance policy based on dividend mutual funds, correct?
No. Mutual funds are that's a separate thing. So,
Good.
So generally, what you do is you take out the insurance policy. So first and foremost, you have to be able to what I call find an insurable interest.
Yep.
So what that means is ideally it's you.
Yep.
But if you're not insurable, if you have an insurable interest in a spouse or a child or a parent or whatever, as long as you can demonstrate an insurable interest and they are insurable, you can do this.
Okay.
Now, for the vast majority, like 99% of people, they are insurable.
Yep. They're healthy enough.
But there are people that aren't.
Yep.
That's the first point. So once you apply for the insurance, there's the design of it is it's not by any stretch an investment vehicle at all.
Okay.
It is a savings vehicle, and it is completely managed by the insurance carrier or the insurance provider. So whatever the company is that you set up this plan with, they manage the money.
Okay.
You put in, for example, $10,000, and that money goes toward expenses of setting up the policy, and it also goes toward the cost of the insurance. But a big chunk of it goes toward a cash value buildup, and that cash value is what dictates how much leverage capability you have from it.
Okay. What do you mean by leverage capability? Just in layman's terms.
So that all that means is another way I term it is collateral capacity.
Okay.
So if you have a life insurance policy that has, say, $100,000 in cash value in it,
Yes.
then you have on-demand collateral capacity of $90,000.
Okay.
You can access up to 90% on demand without payments.
Why not 100?
Pardon?
Why not the full amount?
Well, you can get 100 if you go to a different lender.
Okay.
But that brings on having to apply for a loan with a bank and so on.
Okay.
But the rules are, and this is more government instituted than anything else, but the insurance companies are fine with it in that you can borrow 90%, frankly, just to give you some buffer because you don't have to make payments. So even though the cash value is continuously growing, like that 100,000 next year might be 110.
Okay.
Then you have the borrowing capacity of 90% of the 110.
Okay.
Okay. So you always have, but again, if you're not making payments, there's going to be interest accumulating against that original 90 you took out.
Okay. Once again, a lot of things there I'm going to try and dissect. So when you say it's always accumulating, why does that $100,000 always accumulate?
Because it has an interest rate attached to it. So it is invested money.
Okay.
Very conservatively, mostly bonds.
Okay.
Bonds, real estate, and a very small amount in the stock market.
Okay. So with that money that's always going to accrue interest and gain over time,
Yes.
you can access up to 90% of that
On demand.
no questions asked.
Correct.
So I call my insurance broker or whoever I call you or whoever I call, and I say, hey, I've got something I want to do. I need capital.
Right.
I can access that.
Yes, you can.
Okay. What are the terms of accessing that? You said there's no terms, but there must be a catch.
There's an interest rate.
Okay.
So the interest rate, and that varies by provider. They're not the lowest, but they're reasonable.
Define reasonable.
Well, generally between right now between 4% and 6%.
That's reasonable. Okay.
So that does, because, and a lot of people get hung up on this too. So it's important to understand is the first question I get a lot from people is, why am I being charged interest to borrow my own money? Mm-hmm. But the key is you're not. Your money is the collateral. You're borrowing the money from the insurance company. So this is creating basically a two asset scenario, because now you're taking that money out.
Yep.
So you have use of that. We'll go back to the $100,000
Yep,
example.
$90,000.
Now you have $100,000 growing while you're using the other 90 for something else, like a real estate transaction or whatever.
Okay, so hold on. This is a good tidbit to pick up on. I take out 90,000.
Yeah.
I have $90,000 cash ready to go, and I'm paying an interest rate of between 4 to 6%.
All 5.
Call it 5% back to the insurance company.
Right.
Okay. I took out $90,000 of 100, and you say there's 100 still in the bank, accumulating interest and growth.
From 100, not from 10, not from the 10 left.
Yeah.
The whole 100 is growing.
Why? Because I took out 90. Why is there 100 left?
Because you didn't take it out. You borrowed it from the insurance company.
Okay.
Again, that's what a lot of people get hung up on. That's why you pay an interest rate.
Yeah.
Because essentially what you're doing, think of it this way. If you had it's like any leveraging scenario really, in that if you have a equity line of credit on a house,
yeah.
Okay, let's just say it's $100,000.
Okay.
Well, you can borrow $100,000 of that.
Yeah.
It'll come with payments required.
Yeah.
Or you could borrow 90,000. You probably wouldn't have to make payments. It's a line of credit, right? It's
Yeah.
revolving. Okay. So think of that. It's exactly the same as that this way, except that the collateral instead of your equity in your house is the cash value in the life insurance.
Okay.
Okay.
Yeah.
So the cash value still sits there at 100,000.
Okay.
So it's gaining interest from 100,000, not 10, because you didn't borrow your money. Your money's still there
Interesting.
inside the policy.
Interesting.
So you create in that scenario, you create $190,000 of use, 100 inside the policy, 90,000 out from $100,000 asset.
That's really intriguing. I'm just trying to wrap my head around this concept. Okay.
Yeah, I thought, like I do this much better with pictures. I'm glad I'm not on camera. So.
Okay. So this tool, I will have $100,000. And I'm just trying to make sure I've got sense of this.
Yeah, absolutely.
We're not even whistling the audience right now.
Sure.
I've got $100,000 accumulating interest, consistently growing year over year. And I've just taken out $90,000. So technically I still have $100,000. No, not technically. I still have $90,000. I have $90,000 in pocket, in hand, ready to go that I can use in investments.
Correct.
And I have $100,000 still in the bank, not in the bank, with the insurance broker, life insurance broker, accumulating wealth on top of that $100,000 that's still in the policy.
Correct.
Okay.
So for instance, the next year, that 100,000 might be 110,000.
Yes.
So that has just created another $9,000 of borrowing capacity.
Yes. When I can borrow 90% of the 109,000.
Yes.
Okay. Now, when I take this money out, I only have to pay the minimal interest between 4 to 6%.
You don't have to pay anything. The interest gets charged, but you don't have to pay it.
How does the interest get charged if I don't have to pay it?
You can it can capitalize the interest.
Okay. What does that mean?
Well, it just means that so again, we'll go back to the same example.
Yeah.
So 5% of $90,000 is $4,500.
Yep.
Am I doing that right?
I hope so, because I'm not checking your math.
Yeah. So if you didn't make payments on it at the end of the year, you'd have let's just say it's 110 in cash value, but now you owe 94.5.
Okay.
Because you didn't make any payments on it.
Okay.
So, a good example of this, when a lot of your listeners are in the real estate world, is this is an ideal asset for a house flipper.
Yeah.
On demand, they go grab some money.
Yep.
They just ignore it until they sell the house. In fact, I've got a real life example. We did this a few years ago, and so I'll talk about that in a second. But yeah, so let's just say it's a 3 or 6 month deal.
Yep.
They put it in, forget about it. So let's just say it's $90,000.
Yep.
And now at the end of 6 months, they owe call it 92,000.
Okay.
And they turn around and sell their property, whatever they get, and then they pay off the loan.
All 90,000 they pay off.
They can,
or
they don't have to,
or they pay off the interest.
They can just pay off the interest and move on to another property, or they can pay it all off. It's really up to you.
Okay.
This is like what I discovered with this, and this like I'll almost get a little philosophical on this too a little bit, is why this was such a bright light on me after being in business for 20 years.
Yeah.
Was I've kind of came up with, and I probably heard it somewhere, but I feel like I came up with it. It really is the Swiss Army knife of financial tools.
Okay.
Because you can do anything you want with it. That's why it's called the infinite banking process.
Yep.
Or the infinite banking concept.
Yeah.
Because the possibilities are really infinite. What you can do with this thing.
It's as far as your imagination can run wild.
Exactly.
Okay. So I suppose my next question was going to be, why should investors know this? And you just said it. So I guess I'll go on my next question. What You just said you had a real life example. What and how did you use this strategy to get profit out of it? What did you do?
Okay. So my wife and I and a partner. So like we had this is a friend, a good friend of ours. He was buying a mini home to flip.
Yep.
And at the last minute, he was trying to come up with all the money. The last minute, he called us and said, you guys want to come in on this? And I didn't even look at it. I just went on his opinion.
Okay.
And wrote the check for it. It was $38,000.
That's trust.
And we well, our name went on it. Like it wasn't just his name on it. So we bought it, $38,000, put about 20 into it, and sold it for $79,000. From the day of closing of us buying it to the day of closing and selling it was 90 days exactly.
Okay.
And we made, after the real estate fees, I think it was around $18,000 that we split.
Okay.
So I used full leverage. I borrowed the money from the life insurance.
Okay.
Even even the money that we put toward the repairs, took it all the life insurance, didn't pay anything on it, sold it, and we come out with whatever $9,000. And even if I mean, after 3 months, it was still a good return, even if it was cash.
Yeah.
But it was infinite because I just used all borrowed money.
Okay. Once again, done a lot on me trying to process this. So your friend calls you, says they need $38,000. You take $38,000 from your life insurance policy.
Yep.
You put 20 into the home of that $38,000.
Yeah. Let me be clear. It takes about 3 to 5 days to get money from your life insurance policy.
Okay.
I happen to have a line of credit too, so I was able to write the check right away. But I immediately replaced it because I wanted to do the process. Like this was the first time. This was 3 years ago. This was the first time that I did it for an investment. I did it for consumer loans before that.
Okay.
But this was the first time I did it for an investment. So I definitely wanted to use the life insurance just to kind of get the feel. And plus, the interest was a little less on the life insurance than the line of credit.
Okay.
So I wrote the check just to get the deal done because it was so late in the game.
Yep.
And then I just took it and paid off the line of credit.
Okay.
And then I took another, I think it was 15 originally out. We ended up spending about 20 on the renovations. And I just took that right out against the policy and parked that in the bank and let them spend for the 2 months or 3 months they were working on it.
Okay. So just going through the whole process from start to finish, guy calls you $38,000. You write a check off the line of credit. You take
Correct.
the $38,000 out from your life insurance policy. You pay off the line of credit.
Correct.
Okay. You take of that $38,000, 20 went into the house, correct or no?
No, additional.
Okay.
I took an additional 15 out against the insurance policy to cover repairs.
Okay, so you took out a grand total of $58,000 from the life insurance policy to cover this whole thing.
Yeah, well, yeah. I mean, I call it 58. We put in 53, and then the other 5 came from.
Okay, so
my
15,
partner.
so 53 total from the life insurance policy.
Yeah.
You sell it for 79,
I think it was. I can't remember, 3 years ago.
After real estate fees. I mean, it's a mini home for 79. They can't be too extravagant.
Yeah.
By the end of it, you walk away with $9,000 each.
Yep.
How did you pay off $53,000 on the life insurance with $9,000? Because this is where this is where I'm getting.
Sorry,
okay.
It was. Yeah, we got the full 79. That was
Okay.
I mean, that was just call it the mortgage, right? So
Yes.
The net difference that came out of it.
Okay. Good.
So we're into it for 58, sold it for 79. After real estate, it was.
Yep.
I think it was a fixed. If I remember correctly, it was a fixed. Like it was a what do you call it? A flat real estate.
Yeah,
fee,
flat real estate fee.
or whatever
Yep.
it was. So it came out to $18,000, and it might have been a few cents in the difference, but in profit. So
Yep.
so we owed 58 total.
Yes.
and
Paid off that.
and received 76. I guess it was.
Yeah.
Something like that.
18, you had 18,000 to 58. You're at 76.
76.
So
yeah.
9,000
So we
each.
received the 76, paid everything off, and ended up with
Okay.
$18,000 left over.
So you take out this $53,000 loan. I'm just trying to really get this for the listeners.
Yeah, absolutely.
During those, you said it took 3 months, start to finish, sold.
Yep.
Okay. During those 3 months, what was the interest payment you're paying? And did you pay it?
Back then it was 3 years ago. It was a little higher. I think it was. I can't remember. 5.25.
5.25. So 5.25 is the interest rate. You're paid off. And did you make the payments? Because you said you don't have to.
I didn't on purpose. Like I could have.
Yeah.
Like I could have. Like I said, I had the money to do it. I just wanted to do the whole process.
Yeah.
As if the way a flipper would do it.
Yeah.
And so I just ignored it.
Okay.
Yeah.
You took it out, left it alone,
Yeah.
and then you just paid it all off at the end of the 3 months, no questions asked.
Correct.
And that was it. And
That was it, done.
and you still have that money in your policy to take out any time of your pleasure.
Yeah, it was actually higher at the end of the 3 months because it goes. That's the other thing too. That we go back to the insurance policy and how these things work. They are guaranteed, right? So once you have that, in this case, I had about 70,000 in the policy at the time.
Yep.
That got bigger every single day. That
Okay.
70 goes to 70,200, 70,500, whatever it is, right? Every single day that gets a little higher.
Okay.
Once it gets to a certain point, it's never going to be lower than that. It's guaranteed to always be at least that and higher again.
Why is that guaranteed? You probably already touched on it, but I want to make this clear.
It's contractual. It's contractual in the insurance policy that it has guaranteed values and guaranteed growth attached to it every single day.
Okay. You're just blowing my mind. Okay. So you took this real life example of the life insurance policy to create this way to go through a house flip.
Right.
What this infinite banking model, become your own banking model that you use in everyday life, this can be applied to across all spectrums, however you want to do with this money.
Yes, exactly. As a consumer or as an investor, or even for expenses for that matter.
Okay.
There is like, I took out a policy back in 2017, 17 or 18, 17. That was, I designed it for a fixed expense. Now with the, it's taxes, but we'll call it rent just because I don't want to talk about taxes. They get me angry.
Rent. Okay. We'll call it rent.
So I took out a corporate owned policy.
Yes.
And I started paying with, so I have so much in expenses each month or each year. And kind of to set this up, I kind of had to do a double dip, so to speak. So it's an expense that I accumulate during the year.
Yep.
Accumulate the capital for, but instead of paying it at the end of the first year, I bought a policy with it.
Okay.
And then borrowed money back to pay the expense.
Okay.
And I'm doing that annually with the anticipation of a windfall.
Okay.
So this is preparing for a place to park money from a windfall, whether that be from a real estate sale, a business sale, winning the lottery, whatever.
Yeah. You're just preparing to win the lottery.
I'm preparing. Exactly. So essentially what happens is people that are in business, people that are constantly looking for to grow, whether it's personally or economically.
Yep.
Life is going to happen, and there's going to be windfalls along the way.
Okay.
Whether that be that could be as easy as you ended up selling a car for 15 grand, you thought it was only worth 10.
Yep.
It's still a windfall. Right?
Yep.
So really what it is it goes back to this whole thing of warehousing your wealth, so to speak. So what I say to people a lot, and again, I'm kind of getting a little tangent in here, but your money has to reside somewhere.
Yep.
So it should reside in your own bank.
Okay.
So because these policies have tax benefits, they also have limitations on how much money you can put into them in relation to the death benefit. So in order for a windfall to be put into it, you actually have to owe money on the policies.
Okay.
Because otherwise you'd have to, or take out a new one.
Yeah.
Right.
Yeah.
And with a windfall, it's a little hard to do because they tend to be annual deposits. I mean, you can get them paid up in 4 or 5 or 6 years.
Yeah.
But you'll never be able to pay one off in 1 year. So if you're dealing with a windfall, the only way you're going to be able to park it all is to have debt against it that it can pay off against it.
So like taking out that $90,000, get
Exactly.
a $15,000 windfall, put the windfall into the life insurance policy. That goes on to
the debt.
That's your debt. That goes on to your $100,000 original life insurance policy, which is accumulating interest day over day.
Correct.
Okay.
This may take more than one podcast.
You can, I'm sure you can see my eyes just trying to like do the math.
Yeah.
Okay. Now when you brought up the death benefit, what is that and why is that important towards life insurance policy?
Well, again, the life insurance, number one, don't forget it, is life insurance, the institution of life insurance, as they call it in my business, has been around longer than our current tax system.
Yes.
When our current tax system came into play, life insurance was given an exemption because, and pardon the somewhat sexist comment here, is the life insurance was created to protect the widows and orphans of the world.
Because we're going into world wars and stuff back when taxes were first implemented.
If a man died, the man was always the earner.
Yes.
Back in this 19th century.
Yeah.
Okay. So the idea of protecting the widows of the orphans of the world, that mantra caused when taxes came into play, they exempt it from taxes.
Okay.
So death benefit was exempt from tax, but so was the cash value buildup, and so was the use of that cash value buildup. Now there are some intricacies with that we absolutely way beyond the scope of this podcast.
Yeah, do not get into more intricacies. I'm already struggling.
But generally, the way I always tell people, and again, this really goes down to the coaching part of it, is you need somebody that knows what they're doing with this. Like any life insurance licensed individual can sell you one of these, but he's not necessarily going to know, number one, if he sells you the right one, because it has to be specifically designed. Like I said, only 0.25% of all policies get written this way. If they do happen to write it correctly, they also need to be practicing it, because there is some specific things that you need coaching on as to how to use it properly.
Okay. And you provide this coaching?
Absolutely.
Yes. Okay.
Absolutely.
So when you can create this policy for anyone that wants it.
Exactly.
Okay. So you have a license to be able to write this policy in a certain way that these people can benefit by becoming their own banker.
Exactly. So in addition to the licensing, I'm what's called an authorized practitioner of the infinite banking concept.
Okay.
Which there's people that are licensed in Nova Scotia that don't live here, but there's only 2 resident here, is myself and one of my partners.
Okay. So you are authorized to use this policy,
or
is that
process.
This process?
Yeah.
Okay.
So separate the policy is just a tool. I'll give you another little analogy here.
Yes,
right?
please.
Is the policy is the tool, and anybody in real estate can understand that if you hand somebody a tool and they don't know how to use it, they're not going to turn out a very good product with it.
Yeah.
They may even break the tool.
Yeah. Yeah.
Okay. So when you bring in the tool,
Yep.
which happens to be the life insurance policy,
Yep.
you better know how to use it properly, or you're going to break it.
It's like a credit card.
Exactly.
Debt.
So you need that's what the
Clarity in that analogy. The credit card is a tool and you can hurt yourself with it. The life insurance policy is not a credit card. Please don't look at that analogy. Try to compare those two.
Absolutely. Yeah.
We're talking about
it's an asset, wrong side of the balance sheet.
Yeah, we're trying to I'm not trying to confuse you guys any more than is necessary, because I'm already confused.
Yes.
So this policy, this tool, this device, you help the individual learn how to put this in application in real life experiences.
Absolutely.
Okay. So they have a mentor, they have somewhere to go, they know where they can get the tool.
Correct.
How do they get the tool? Call you?
Well, yeah, just to start with is we just say we have a conversation, and then I kind of when people come and already know that they're coming specifically about infinite banking.
Yeah.
It's a more simple conversation that I have than just a referral. Like, you need to talk to this guy.
Yeah.
Right.
Yeah.
So if you already know then there's still a discovery process that I go through.
Oh, I'm still discovering.
Because part of this process is understanding what is sustainable.
Yes.
And that's based on the individual.
Okay.
So because you do not want this thing to blow up on you. All right. Because like if you're saying, oh, well, I'd like to be able to pay cash for a $500,000 house in 5 years. Okay. So what am I going to do? Well, I'm going to put $600,000 in this thing in the next 5 years. And you're like, okay, where's that money going to come from?
Yeah.
Well, I'm just going to borrow it back from the policy. It doesn't work that way, right?
Okay.
So people get certainly take this and create their own ideas with it. That again, the coaching part of it becomes way more clear.
Yes, of course.
And again, a lot of times with people, and it's funny, I'll bring up too is if this is so great, I hear this all the time. If this is so great, why doesn't everybody do it?
Huh?
And there's a key thing to that, is everybody that understands it, not just everybody knows about it, everybody that understands it does.
Yeah.
I've had a few people come through, not many, but I have had a few people come through my door, and they just couldn't get it. And they left.
Yeah, because it's fear, right? It's fear of the unknown. It gets like you mentioned that, but I say that all the time in real estate. For somebody who's never bought a house before, they say, how's the market? I say, oh my God, it's great. You should get in. Not right now. It's tough for buyers. Let's be real. We're not going to say it's a hunky-dory for you guys. I understand you have my sympathy. But like you say, be in real estate. It's a good time. Price points are going up, blah, 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 blah.
Absolutely.
If they don't understand how to buy a house start to finish and they don't even want to begin to learn, you're going to see the fears in the eyes. If we're having this conversation with a buyer, if I'm having this conversation with a buyer, I'm probably at a party having a drink in my hand. We both take a sip of a drink, lock eyes. You see the fear. He leaves. I keep drinking.
Well put.
Typically how it goes.
All right.
So back to this life insurance policy. We know how to get it, where to get it. Now, in real life applications, for the people that are listening, because there are some investors that keep on touch with this stuff.
Sure.
What are some real applications that they can have, and why should they get this policy for themselves?
So, well, the first thing, I mean, we went through a whole example of a house flipper.
Yeah.
Let's go in another direction of somebody that's just acquiring rental properties.
Okay.
Because this is kind of the kind of thing that I did as well. Actually, before I discovered the policies, but I did this. So, and this might be a little hard to explain, but if you look at this from the perspective of, we'll go back to the $100,000 example.
Yeah.
You got $100,000 in cash value. You got $90,000 in cash. So let's just say you say, okay, I'm going to buy a $250,000 property.
Okay.
With 20% down.
Okay.
Okay. So you borrow $50,000 against that policy, and you use that for your down payment.
Yep.
Let's just say you pay your own closing costs.
Okay.
So if your return on that rental,
yep,
let's just say your expected return was 20%. Okay. Now that you've almost made it infinite, except for the closing costs, now you pick that 50%. Why? Because you only got, whatever, $5,000 into the deal, or $7,000, or whatever your closing costs.
You only got, because of the closing costs.
For that matter, you can borrow it all and you got an infinite return.
Yes. Okay.
But you still have the cost of borrowing that money.
So the interest rate.
Right. And also you've taken up some of your collateral capacity. So you've used some of your debt. Okay. And you have an interest cost. Okay. But that interest cost, think of it this way. There's actually an opportunity here to actually make money off of that. And I use this in a seminar, so it's a little easier to show.
Yeah.
But let's just say that same example. So you took the 50 against the insurance policy, and the insurance policy was charging 5%.
Okay.
That loan, or that interest on the loan, is tax deductible, correct?
Yes.
Yes, it is. So in a 50% tax bracket, your cost is 2.5%.
Okay.
The average annual return inside the policy is about 4%.
Yeah.
And here's where it gets better. Tax free.
Yeah.
So you're using the money, deducting it, getting interest on the collateral, tax free.
Okay.
There's an interest arbitrage there.
Interesting.
So that's one thing. But the other thing I just wanted to get to with okay, so let's just say you got this $250,000 property.
Yeah.
And it's generating, I don't know, whatever, $400 a month in cash flow.
Yes.
Just pick that number.
Pick a number. $400 cash flow.
Take that money if you don't need it. If you're using it for your life, then that's a different story. But if you take that money, start funneling it back in, pay back the policy, all you're doing is creating additional capacity to do it all over again.
On the 100,000.
Exactly. As the 100,000 goes up, that $50,000 loan goes down. You're just creating that bigger and bigger capacity to be able to expand that rental portfolio network.
Yeah.
Portfolio. Sorry.
Okay. I'm with you. I'm slowly I swear I'm trying. Okay. So I've taken out the 50. I'm using the rental income, $400 a month to pay it down. That'll increase the $100,000 loan capacity I have while paying that loan down, which means I can take out again another 100. By this, I'm just trying to figure this out in my head.
Yep.
So I've taken out 50. I'm paying out $400 a month, which will increase the capacity of 100K by X amount of days over time, over interest gain, blah, 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 math.
Yep.
We get it. Say now I'm just paying off the interest on the 50K. That's all, not the original 50K. And my capacity is going up. Does that mean I can take out another 100? Let's say that for easy example's sake, you can tell I'm rambling because I'm trying to grasp with this thing.
No problem.
I can take out another 100 again or 90 again because that capacity is still there. If it just stayed at 100, could I do that again?
If it was still at 100,
yeah. After taking out 50.
You can take up to 90 total.
Okay,
So
total.
if you still owe the 50, you got 40 in capacity.
Okay, good. I just want to make sure it wasn't just like I'm pulling loan capacity is 90.
It's good.
I'm just
it's not
pulling.
that good.
I'm pulling 90 every day. So we still have to pay back that 50 grand.
Correct.
Okay.
Well, you don't have to, but yeah, it makes sense to.
Yes.
As long as you're actively, I always tell people, as long as you're actively working or actively earning, I should say, not working. I don't like to use the word work, but actively earning.
Yeah.
Make an effort to pay back your loans, because if you don't need this money, again, your capital has to reside somewhere. It may as well reside in your bank.
Yes.
Because you can always, like, if you're sitting on 10 grand in a bank account, why? Throw it against the 50 grand,
Yes.
knowing that you can always pull it back if you need it.
In a heartbeat.
Exactly.
And
It's on
wait, in
demand.
3 to 5 days.
Exactly. Yeah, that's right. A couple of heartbeats.
There is a turnover period.
Yeah.
Okay. So let me ask this. And I'm going to talk about the loan amount. Well, not the loan, but the collateral amount of 100 grand.
Yeah.
Can you maneuver the policy to give you more leverage?
Well, I'm not sure I understand the question.
Yeah, I'm just trying to okay, let's say instead of 100, I want 200, or I want 300, I want 4. Can you build the policy so that you can have more money for leverage?
Yes.
Or no?
Yeah. So yeah, you can. It's again, but it's all dictated by the coverage that you have. Like the amount of tax. I don't think I finished that concept when I was talking about how the tax got exempt in life insurance. So it's all tied to death benefit. So a specifically designed policy that does this, you want to what we call max fund it. So we max fund it. So if a policy costs $4,000 a year to buy on a base, on the base, then you're likely going to be able to put about 10,000 into it and keep it all tax free.
Okay.
That additional 6 in that example,
Yes.
that's generally just going right to your cash value and going to actually increase your coverage. And that's key too, because increasing the coverage increases your capacity to add cash value. Because again, the tax exempt part of it is always tied to the death benefit. Higher the death benefit, the higher tax-free capital space you have.
Okay, and what now? I already asked this question, but I want clarification. And what is the death benefit again in a life insurance policy? What is that for?
That's exactly what it was set up for. It was to protect those widows and orphans of the world.
Yeah.
But really, it's a death benefit. If you die, it pays.
Okay.
So let's go into that a little bit too, because we got two things going on here. So you got let's just say it's $100,000 cash value, but $1 million life insurance policy.
Yes.
So you have $1 million death benefit, $100,000 cash.
Okay.
Okay.
Yep. You got 10%.
If you have that, then the policy probably started in death benefit at about 800,000, because the death benefit grows faster than the cash value.
Okay.
At least in the early years. They meet at age 100, by the way. But again, way beyond the scope of this.
Yeah.
Okay. So if you pass away, this is a self-completing plan. The $1 million gets paid after any debts against the cash value or the policy, again, because it really is a collateral against the death.
Yeah.
So if you owe $90,000 in that policy, the net death benefit will be $910,000.
Oh, it pays itself off.
It pays the $90,000 off and then pays the remainder to your beneficiaries.
Okay.
So there's always a death benefit attached.
Yes. Yes.
And that's what keeps the tax exempt status of the cash growth.
Yes, because it will always pay itself off at the end.
Exactly. So you're in a need, like people say, well, how can an insurance company just lend you money without even asking any questions? They're in a very unique situation where they are the guarantor and the lender.
Yes. Okay.
It's a very rare scenario.
I mean, I don't know any other institution that does that. And you see, no one sees you shaking your head no.
That's right, yeah. Oh yeah.
So this is okay. I'm just bear with me in my I'm like rubbing my head trying to like figure this. It almost sounds too good to be true.
Again, I hear that all the time. It's too good to be true. Why doesn't everybody do this? If it's so great, why doesn't everybody do this? It's too good to be true. And it really, I mean, it's not perfect by any stretch. Like when you say it's too good to be true, like understand that there is a capitalization phase as well. So what that means is you can absolutely use the money immediately.
Yep.
But not all of it. Right?
Okay.
Because there are some costs involved in paying for the insurance, paying for the setup, and so on. Okay?
Yes.
So if you put 10 grand in, your immediate use is going to be about half of that.
Okay.
At the end of the first year, you'll get about 70 to 80% available to you.
Okay.
Okay. Of what you put in.
Yes.
Okay. 5 years in, you're going to have, that's when you kind of catch up when I say.
Yeah.
So that's when you're 50,000 in, we'll have $50,000 of cash value.
Okay.
Will be about year 5 if it's set up properly.
Yeah.
Okay. Now understand that like that almost contradicts. I'm sure there's some people that will listen to this at first and say, well, wait a second.
Yep.
Didn't you say it gets 4%?
Oh yeah. I'm with you.
Okay. It does over time from day one, but it just makes more in the later years. There are some setup costs. So it's like, I've heard a term this way, like, becoming your own banker. Okay. What are you doing? You're starting a business of banking. Okay. Any business that you start, you have to capitalize.
Yes.
Okay. So this is what you're doing is you're capitalizing a second business. Like the original writer of the book, Becoming Your Own Banker, Nelson Nash, the late Nelson Nash, he died a couple of years ago. He said everybody should be in 2 businesses, whatever they do and banking.
Yeah.
And you need to capitalize that. You need to capitalize that business, but you need to be in the banking business. It's the most important business in the world. No other business can operate without banking.
Yep.
That tells me that's probably the most profitable business in the world as well.
I mean,
And
yes.
really all banks do is they move money.
Yep.
And if you create your own bank, although we can't lend it out 9 times like banks do, the same dollar, we can certainly act like a bank and make it very worthwhile.
Yeah. Okay. So I'm still processing a lot here. Okay. So I'm going back to this example where we $100,000 loan capacity or leverage capacity, because you can't, it's not a loan. So it's a leverage. This is a tool to be
collateral
used.
capacity.
Yes. Collateral capacity. I take out 90. What happens if I never pay it again?
If you do that right away, it might survive. Like understand that you're going to have that the cash value will grow. So if you borrow, like if you how old are you? 29?
I'm 28. Thank you.
Look a day over 29.
I'll be 29 in 3 weeks, like literally 3 weeks.
So if you borrow $90,000 against $100,000 of cash value,
Yeah.
and never make an interest payment, it'll probably because we're early enough in your life,
Yeah.
that interest will probably cannibalize your growth, and the policy will have to cancel.
Okay.
Okay. But if all you did was borrow that 90 and paid interest only, the 100,000 is going to keep growing inevitably. So you'll just always have that $90,000 of debt.
Huh.
Okay. So if all you did was pay the interest,
So hypothetically,
you would never have to pay it back.
so based on what you're saying and I would say hypothetically, but in realistic terms, let's just say I paid I take out the 90, $100,000 and I just cover the interest, and that thing, I can't go in approximate time, but let's just say it gets up to 200.
Right.
Could I take out again? I never paid the 90, but I've been paying the interest. Does that mean I can take out again more money up to the 200 where that 90% threshold is?
Yeah. Yeah, absolutely.
Huh. So
Yeah. Like as soon as there's more than 90% available, that's more collateral capacity for you.
Okay.
Incidentally, I want to finish that thought too about you saying about never making a payment.
Yes.
So what I tell people, as long as they're actively in business or at work,
Yeah.
endeavor to pay off your loans or pay the interest.
Okay.
More or less pay it off, because there is a separate strategy, again, way beyond the scope of this, that once you get to that point of, like, I hate to use the word retirement, but everybody relates to that retirement age.
Yes.
There's a strategy that's available that where all you do is you basically shut down paying for the policy if you haven't already paid it up, and you can start taking a stream of income from it, tax free for as long as there's cash in there, and never make a payment on it, because it's been enforced for so long now.
Yeah.
It's going to grow that much faster. Every year these things get better. Okay.
Okay.
So the death benefit, cash value grows. You borrow against that, tax free. Again, there's some setup, and you need some coaching on this.
Yeah.
That you can actually take an income for life, tax free.
Okay. I'm just going to let the dust settle on that.
Again, it's like I said, I mean, I could go on and on. Like I could literally do a whole other, well, I don't know if podcast is the right format because I would need pictures, but like, cause I'm talking like I'm picturing a picture I draw for people.
Yeah. Yeah.
That's how I'm talking. So I'm sitting here saying, okay, so you ladder up over time.
Yeah.
It's almost like a line of credit. At that point, you just set it down. It's a line of credit that you never pay back.
Interesting. Okay. I mean, I'm still okay. My next question is, you say you work with people and you coach them in this topic, right? And you help them use these tools. Can you give an example where this tool greatly benefited someone off the top of your head? In real life, just in real life.
Other than myself, I just bought a cottage in Shediac in September. I paid all cash for it, but it was all cash value.
So what'd you do to buy the cottage? How much was it?
It was $166,000.
Yeah.
And I borrowed $170 from my insurance policies.
Okay.
Covered some closing costs as well. And it's being rented out now, and it's producing $1,400 a month in the winter. It's in Parley Beach, so
yeah.
We're planning on short-term renting it in the summer, and
Airbnb.
Yeah.
Okay.
It's just we're just throwing the $1,400 back against the policies each month right now.
Okay. So I need a breakdown of this just because it's for my own thing. I'm trying to understand this as we talk. So you see the college in Shediac, $166,000. You take out the policy. You go to the policy to take out the leverage for $170,000 cash. It takes 3 to 5 days to get in your account.
Yep.
And does it go direct deposit?
Yep.
That's nice. So you got $170,000 direct deposit in your bank account.
Exactly.
You pay it all off, cover the closing costs with the 170. What's your interest rate on it?
That's from a couple different policies. One is around 6. That's the smaller one. And one is 4.45, I think.
Okay. So 10% interest.
Yeah. So yeah, our plan is to refinance it actually, but we're going to do, like we already put a heat pump in.
Refinance the house.
Yeah.
Okay.
The cottage. Yeah.
Yeah. Okay.
It's on a foundation. Now we put a heat pump in. We're going to build a shed for it, and we expect to get more rent than the previous owners were getting.
Yeah.
So at that point, then we'll refinance and I'll just pay off the loans. Right?
Yeah. Okay. So and now you're just using the $1,400 a month rent right now to pay down the interest. And are you making any payments to the policy itself or the leverage itself? Okay. So
so it's I haven't even calculated it, but I mean the $1,400 more than takes care of the interest.
Yeah.
What is the interest? Let's call it 5%, and it's 10,
take your time.
Be 10, 70.
Math is hard.
About 8. I don't know. So about 800 of its interest, I guess.
$800 of that is interest.
About 800. I literally haven't even looked at it since. I've just been throwing the money on them, and it was just in September, right?
Yeah.
Yeah, I think it's around. The interest is probably about $800 a month.
Okay.
Property tax or.
Now you mentioned something interesting there. You have a policy for the 6% and you have a policy for another 4%. You have 2 life insurance policies?
I have 6 for my household, actually.
You have 6 in your household?
Yeah, 3 on me.
Okay.
1 each on my children.
Yep.
And 1 on my
wife.
Actually, insurance policies. I have 7.
Okay.
One is the term insurance that I'm going to convert for my wife, but that's a whole other story.
Whole other story. Understand it.
She wanted an iPhone or an iWatch. I mean, there was a deal. So, anyways,
okay.
so there was, so I have, so 3 on me. My kids, I set them up. My daughter's actually type 1 diabetic.
Okay.
And so her policy was, it still works great, even though she's I went to hers is actually with Sun Life.
Yep.
They're the only company that would look at her before she was 18 years old because she's type 1.
Yep.
And it's rated. I mean, it's they insured her, they didn't turn her down. But they did rate the policy, so it costs more for the insurance portion.
Yeah.
But it's still pumping out cash.
Okay.
To my own surprise, I was going to pay whatever it was because I didn't want her to not have something that my son had.
Yep.
And
what a good parent.
It's still doing well.
Yeah. Okay. So you took out so for you have 3 of these policies under your name right now.
Yeah, total of I got about 3.2 million in coverage on myself right now.
And what's your max? How much leverage in all 3 combined?
My 3 and my wife. So I separate the kids. I don't use theirs for,
You don't touch the
for our
kids.
stuff.
Don't no, that's their inheritance. Don't take the kids away.
So the last time I looked, we were at, actually, this is kind of a funny exercise I went through because I was tracking it before I knew we were looking at a cottage in the summertime.
Yeah.
And we had gone up from, now I did have an anniversary in there, which is a whole other story, but of how that affects your cash values. But I went from actually February of last year to September.
You tracked it.
Yeah. And we went from $189,000 of cash value to $235,000 by September. There was an anniversary in there. So that, again, it's not pure return.
Yeah.
There was some money added to it as well.
So right now,
right now, I mean, I haven't looked, but my guess would be it's around 260.
okay. So right now you have $250,000 that you can just access. And
Minus what I used for the cottage.
mine is what you use for the college. So you probably have access to over $90,000 in capital that you can just, you see an opportunity in real estate or in life or stocks or whatever you do. You see an opportunity.
Exactly.
You're going to call them and say, hey, give me the 90. They're going to send you that 90, 3 to 5 days, 90 grand hit your bank account, which is just lovely.
Yeah.
And then you're going to go out and you're going to make whatever move you think is the opportunity.
Exactly. And I do focus on opportunities with this, but it really does, like, what a lot of people find hard to believe, but it really is if all you did was consume with this thing. And when I say be a consumer, so buy your cars, take your vacations, whatever what I call events that you either have to save or borrow for it anyway.
Yeah.
That doesn't come from your monthly expenses.
Yeah.
If all you did was use it for consumption, you won't be rich, but you'll be better off than if you didn't do it.
When you say consumption, just consuming goods and not paying anything back, or are you paying the interest?
No, you pay it back because you would pay it back anyway. If you take out a loan for a car or lease a car, you got a payment, right?
Yes.
So just do the same thing, but you're the bank instead of instead of Ford Credit or Scotiabank or whatever, right?
So you have to be very good with your money. If you're gonna,
you got to be a good steward of your money in order to, like, I mean, there's lots of flexibility into this. And that's why I said, like, you can put a good tool in someone's hands, but they'll break the tool if they don't know how to use it.
Yeah.
Right. So it's not something to just go take out and say, okay, this is my my well of money.
Yeah.
It's a warehouse of wealth.
Yeah.
It's not a well. It's not a bottomless well.
There is capacity.
Exactly.
And you can reach full capacity if you just abuse the system.
Absolutely. You can.
Okay. And if you abuse the system, I imagine you're not going to be able to get another policy in your name.
No, actually you can. It doesn't. That doesn't affect anything. Oh yeah, but so yeah.
The banks
that would be detrimental to yourself only because these policies, every year you own them, they get better.
Yeah.
So if you let one go after 7 years and then start a new one, you didn't accomplish anything but starting over.
Yeah.
Right.
Oh my.
You might as well repair the 7-year-old one and start a new one.
At least banks will cut you off if you abuse them.
Well, that's the other thing too, is none of this never shows up on a credit report.
Okay.
Okay. It has nothing. And this is important for your real estate investors as well, is cash value in an insurance policy. When you go to a bank for your conventional portion of your financing,
Yes.
it's not considered borrowing your down payment when you use cash value because you are able to withdraw it if you want. It's considered cash. It's not considered like, you say, oh yeah, I got a line of credit over here for my down payment, and banks are like, whoa, wait a minute.
That's debt though.
That's bad.
That's debt ratio.
Exactly.
They're going to look at that ratio, TDS, GDS.
It doesn't touch the credit report, and like you can show it as cash value on your asset statement when you go to apply for your conventional financing, and it's still cash. You can say, this is where's your down payment come from? Right there. Oh, okay. It's cash.
You can literally say
it's considered cash.
Yeah. Okay. So that's a really good topic to dive into. So, and then an example, this isn't going to be long, but I need a down payment for a house.
Yeah.
I call the life insurance policy and say, hey, I need this X amount of dollars to cover this 20% down payment because as a real estate investor, 20% down if you're not living in it. So get the money in my bank account, go to my mortgage broker or my bank and say, hey, I'm ready. They say, where's this pile of money coming from? Are you a drug dealer? You say, no, I get from my life insurance policy. And then they say, okay, cool, it's cash.
Correct.
That's it.
It doesn't even have to be withdrawn from against the life insurance yet. You can just show a statement of the cash value existing in the life insurance policy. You don't even have to put the money in the bank.
And that's just considered cash.
Considered cash. Yes.
That's hilarious.
Nice, it works.
That's
It's helpful.
yeah, that is okay. And because like typically speaking, when you take out a loan for a down payment, it's always going to show up in your GDS, TDS, gross debt ratio, or
Total and gross.
total and gross debt services, and they use on the ratios to qualify your loan against you for the mortgage, which means it'll impact how much you can borrow from the bank. Where in reality, if you just do this strategy, you bypass the down payment, you still need the mortgage from the bank, unless you can take out.
Unless it's like me with the cottage, I had enough in there. I just paid cash.
Yeah. And you only make the necessary payments of 5%, which is still larger than today's rate of mortgage rate.
They are. I mean, it's like I said, the payments, or sorry, the interest on these. And so, like, understand too that, I mean, I could get real philosophical on interest rates, by the way, and because there's a reason why banks focus on interest rates.
Yeah.
Is because people get attracted to that.
Okay.
But that's only one factor. You can't spend 1%.
No.
Right. Most host flippers get that. They readily pay 15% for hard money.
Yep.
Because they know they're going to make 80% on the deal or whatever it is.
Yeah.
You know, they know that, okay, the interest is going to cost me $8,000, but I'm going to make 40.
Yep.
Duh.
Yeah. Because if you don't, but that's the difference though, is that a house flipper, for this example, in terms of real estate investors, they're only in the house for 3 to 4 or 5 months, 6 months. Like that 15% is not going to do enough damage.
Exactly.
Versus someone that is buying a house for a 25-year amortization period.
Absolutely.
Who lives in an average householder lives in a house now for 5 to 7 years. So in 5 to 7 years, 15% on a monthly mortgage payment, that can do some damage. That can,
absolutely. It's going to cost you more.
Yeah.
So yeah. And it's like I said, it's one part of the equation.
Yeah.
It's not the only part. Like most real estate investors understand that terms are everything. Interest rate just happens to be one of them.
Yeah. Yeah, it's just if I'm going to get 15% mortgage, but I get $10 million, and I realize on the house flipping, and these are exaggerated examples, people, this does not really happen. I'm sure someone's done it, but like anyway, 10 million of the deal is going to give me 30, but I'm going to eat 15% for 3 months. Well, okay, I think that's a big enough return. I can live with that 15%.
I think I can live with it.
Yeah,
Exactly.
Scott, I'm out of questions. Thank you. You can end this on whatever tangent you want to go on. So, I am done.
Okay. So yeah. So I will just will make a comment about control.
Okay.
Because one of the things that a lot of people ask me is like, really, what is the benefit, right? Like, yeah, you got this money, but it's really about like there's two things going on that are very almost imperative to understand. Is what you're doing is you're creating a maximum amount of control of your capital.
Yep.
And you're having uninterrupted compounding of that money forever. Understand that compound interest, like Einstein termed it the eighth wonder of the world.
Yep.
Or he's credited with coining it. He didn't actually say it that way, but anyway. So the eighth wonder of the world, it only works if you never spend the money.
Yes.
But what if you had a mechanism or a process or a product that allowed you to use that money, but never actually spend it? So that is ultimate control.
Yeah.
Okay. And when you're in control of your capital, like you have money in it, like, I have conversations all the time with people. It's like, they talk about, I got to buy an RSP. I got to get this tax deduction and so on. It's not really deduction. You're still going to have to pay it back. It's a deferral.
Yeah.
Okay. But what you've also done is created this black hole of money that you can't really, it's in jail. Okay. If you use that money and set up something like whatever it is, a savings account or whatever, like to me, it doesn't make any sense much more than to do it this way. The most efficient savings account out there.
Yep.
And what does that do for you? That gives you ultimate control. You can use it to act like more than $1. You can't do that with an RSP. You can't do that with an investment in the stock market. You still got to, you
have to withdraw the money.
You have to withdraw the money.
Which then
it's or. It's not and. This is the true and asset. I've got this thing, and it's funny. People tell me I should patent it. I tell people by the end of my spiel, if you will, after because usually when I have a first meeting, I ask a bunch of W type questions.
Yeah.
And then I just show a couple of concepts to kind of introduce this concept.
Yeah.
And then I finish with, I used to make a joke about it, but it's absolutely true. Is I don't care what you do with your money, just give it to me first.
Banker.
But your own bank.
Yeah. Wow. Now, okay, I did think of actually my last question. For those of people that are listening that want to learn more about this, what are some books, podcasts, or I know obviously call Scott. If you want to learn more about this, please call Scott. Do not call me. You're going to hurt my head. When he says some people get it, some people don't, I'm on the cusp. I'm very close, but I know I've still got like a little more to go. I got more questions. I got to think about this. Anyway, what are some books people can read and some assets that they can use?
Yeah. I'll say this to anybody that's listening to this, then like I'll provide this free of charge. I do have the actual original book that was written called by the late Nelson Nash, is Becoming Your Own Banker. And this book is almost annoying to read the first time because he actually tells a collection of stories to make a point that really only makes sense once you read it a second time.
Okay.
But when you do, it's like, woo, a light bulb goes on.
Yeah.
That's probably the best book to read. There's another one, The Case for IBC. I have those as well. Infinite Banking Concept is the IBC. So anybody that wants to contact me, I'll send them to them free of charge. And I also have permission in a PDF format to issue another book that's written by, the guy was 22 when he wrote it, but he took all his ideas from other books. But
Yep.
And he's 24 now. Caleb Williams is his name, from the U.S. And the book's called The And Asset.
Yep.
And I like using it because he puts it into it's like Nelson's very philosophical the way and Caleb is way more literal.
I read
the
it.
way he explains it.
I read
The
it.
And
Yeah,
Asset?
you gave it to me last week.
Oh yeah,
and I read it.
So that book as well is a very good segue for it. I have started a YouTube page where I show just little anecdotal things. So just all you have to do is go to scottgannon.com or even just look up Scott Gannon Financial on YouTube and you can find me there. As for other books, just all you have to do is go on Amazon and Google Infinite Banking. There's dozens out there.
Okay.
That offer it.
Scott, man, thank you so much for the time. It's been an absolute
Thank you
pleasure.
very much. And so I don't know how I guess you'll put in the show notes if they want to reach out and
everything.
I'll send them the books.
Everything. I always put everyone's contact. Every guest gets their contact information in the show notes.
Okay.
So and I'll also include the link to your YouTube page and anything else you want to be seen on, whether it's Facebook, social media, whatever those things are. Send me the links. They'll be in the show notes. For anyone who doesn't know this, every person's contact information is in the show notes. I don't usually say this on the podcast. Actually, you're the first one to ask where their contact information is going. So I now have a reason to. It's all in the show notes. I'm going to need to lay down.
Oh, sink in.
Scott.
Yeah, like you probably felt like you got fed you thought you were going to take a drink from a hose and you got hit with a fire hose.
I think I got hit with a truck. If you'd like to get in touch with Scott, you can reach him at 902-478-2620 or scott@scottgannon.com. And if you'd like to get in touch with me, you can reach me at 902-220-7357 or jason.paul@kw.com. Thanks again. Bye.